This is Jeff Marshall, and this is the third quarter update for Signature High Income. Please note these comments also apply to Signature Diversified Yield. The biggest impact on the fund in the third quarter was the continuation of the rally from March, with markets pricing in economic recovery and most importantly benefiting from record amounts of monetary stimulus. High-yield bond spreads tightened about 100 basis points despite a record amount of new supply. Infrastructure and real estate equities also rallied but could not generally keep pace with the outsized gains from the technology-heavy broad stock indices. We've demonstrated the magnitude of the 6 largest tech stocks' contribution to the overall index in the slides. Sectors like technology that do not pay dividends are non-core to our strategy of generating income from income-generating asset classes. This is where we can be disadvantaged at points in time when growth outperforms income, and our competitors in global balance funds that can't participate in this market segment can gain traction. Real estate, as an example, is down about 20% relative to broader equity indices in just about every global market, with secular questions in retail and now office. Infrastructure is similarly bifurcated as other asset classes, like with data centers, logistics assets, and utilities outperforming COVID-19 affected sectors like airports and toll roads. Net, the fund outperformed its benchmark in the quarter, firing on all cylinders as the real estate and infrastructure equity segments outperformed, as did high-yield bonds. We saw specific strength from Asia-focused real estate logistics provider ESR and Canadian renewable energy producer Boralex. Aside from elections and vaccine potential, the markets and real economy are now clearly captive to both very easy monetary policy and the fiscal policy bridges that will get us to economic recovery without further job losses and credit impairments. I view the 2009-2015 era as a test run to how income asset classes can perform in a low interest rate environment that precipitates a global yield grab. Returns cannot be as impressive going forward as they were then, however, given starting yields and valuations. Nonetheless, in an extended period, which is our base case of 0% overnight interest rates, only slightly better GIC rates, negative real or after inflation government bond yields, bond market refugees will have to move out the risk curve and gravitate to high-yield bonds, real estate equities, and infrastructure equities. These are not big asset classes compared to government bonds, and we stand to benefit.